All right, everyone. Happy Tuesday. Good morning. I can't watch reruns of, or not reruns, but Monday episodes of The Daily Show with Jon Stewart to get my news. I guess they're off for the season. But I'm still here doing money supply updates, so let's continue on. We're going to focus on the euro today. Very exciting. Very exciting. Here's my survey. This is my monetary base. If you follow the channel, you know what this is. This is the economically, legally, accounting-wise, comparable money supply to Bitcoin. All right, $30 trillion during the peak of the pandemic. Now it's down to $26.2 trillion equivalent. Yesterday we talked about Japan. Here's Japan. $4.36 trillion at the moment. Although back when I was starting this survey, they were actually the largest monetary base for a while, right about here. At about 5 trillion, 5.5 trillion right there. Although the US eventually overtook them, or again overtook them, wasn't the first time. We looked at the US. All right. US is over 20% of the pie. Japan is under 20% of the pie at the moment. These things fluctuate, obviously. Now we're going to look at the Eurozone. All right, here's the Eurozone. It's bigger than Japan, smaller than America at the moment. About $5 trillion equivalent as of March. Let's take it out just to see how it looks compared to the total. The euro is a weird beast, first of all, okay? I'll just point out a couple things. So the first thing to notice about the euro money supply is that the composition of nations changes, okay? Estonia came in here. 2011, my country, Latvia, came in here. 2013, Lithuania came in 2014. Croatia just came in last year. Slovenia, Slovakia were like 2008, 2009. I might be missing those, but somewhere around there. The euro as an idea, or not as an idea, but as a full-fledged concept, started January 1999, right there. All right. Compared to today, the monetary base at the time, remember the monetary base is central bank money. It's what does the central bank print? It is the printing press of the central bank. Compared to today, obviously you can see we're roughly 10x smaller, 10% of what we are today. World totals 2.29 trillion. 25 years later, it's 26 trillion totally. ECB the same, about $5 trillion. January 1999, $450 billion. The currencies of the euro, the original Eurozone members, Finland, Germany, France, Belgium, Holland, Spain, Portugal, Italy, they started to trade side by side, and it was like an accounting sort of mechanism at the beginning for the first couple years. Coins were started to introduce, notes. It didn't really fully get going until about 2002, but we have accounting all the way back to 1999. Before 1999, how am I calculating this monetary base? I've mentioned this many times, but just to make it clear, I'm actually only using 3 countries, 3 central banks. That is the Bundesbank from Germany, the Banque de France from France, and the Banca d'Italia from Italy. Those are the 3 largest subsets of the euro. It's not for want of, trying to put in more, but really the data is actually not that good to find this. So eventually to get like Spain historical data, Belgium, Holland. I've talked to friends and academics about this. I think I have to go to libraries and get hard copies. There's just not that much good data online. So if you have any ideas about how to find prior historical balance sheets for Eurozone nations, that would be helpful. But anyway, just so you know, there's only 3 countries that are included back here. And how am I finding this dollar value? Well, I'm finding the French franc value, the Deutsche Mark value, and the Italian lira value of their monetary bases, then converting them into dollars. So that's how I've done it here. But I want to do a broader money supply survey now for you. So you can kind of see the broader money supplies. People talk about M1, M2, M3 all the time, the broader money supplies. So let's do that now for the Europe. All right, let's just for comparison, here's the United States. Again, crazily, the Federal Reserve stopped publishing M1 somewhere right around here, around the pandemic. They claim for regulation reasons, it's important to now basically have savings deposits in M1. It's completely asinine. It's not backwards compatible. So you have to go back and sort of back into an M1. This isn't exact, but this is basically from the data that the Fed does provide. This is M0 plus demand deposits. That is M1. M0 plus demand deposits. Remember M0, what is that? That's just the Benjamins, the physical cash and coin of the central bank. And in the US's case, the UK's case, there's some overlapping with the Treasury, of course. Coins are minted by the Treasury. Notes are printed by the Federal Reserve. They're actually both minted by the Bureau of Printing and Engraving, but one is a liability of the Treasury, the other of the Federal Reserve. This is for like confusing historical purposes, but of course the United States did not have a central bank before 1913, so the Treasury was minting the money. That's what the Constitution says. But they, central bankers and the bankers had their way, so now we have a central bank in the United States. Point is, the physical, what we call cash, is M0. And the difference between M1 total and M0 is demand deposits, the sacred demand deposit. Now you can see, obviously, it's exploded here during COVID, and that's why we had a lot of inflation. That's why everybody's arguing about where interest rates should be at the moment. But the total value roughly of N1 is about $10 trillion for the United States at the moment. Okay, $10 trillion. This is not included. If you go to the M1 in the Federal Reserve's website, it's going to be higher than this because they're basically included savings deposits. It's asinine. Savings deposits were never part of M1, but now they are in the U.S. There's no point of doing it this way. You don't need to. You can still look at different money supplies no matter what anybody says legally, whatever. $10 trillion for M1 in the U.S. Let's look at euro. All right, this is native euros. The ECB does have, for the original 12, I think it was, ECB members, Euro area members, that is. They do have a backwards compatible series going back to the 70s. So this is what this is, M1. And then you're adding more countries as time goes on here. What's the total today? I have this one as of April, 10.7 trillion euros. can see a big jump here. Obviously, pandemic stimulus happened everywhere. This is Eurozone. Let's go over to Japan really quick. All right, M1 for Japan in native yen. We talked about this yesterday. Big jump here. Japan was experts at stimulus and printing money before everybody else. Big jump here. All right. Let's put it now in equivalent USD. All right, so this is converting the euro balances into dollars. All right, so it looks more lumpy. This is more, smooth here because these are in euros. And actually here it's a backwards compatible rate. We'll get to that. Because remember, again, the euro started here, accounting in January 1999, and then slowly phased in over about 3 years. €10.7 trillion is M1. What does that factor into dollars? $12.1 trillion equivalent is European M1. Remember, this is not the European Union. This is only Euro area. And at the moment, there are 20 countries in the Euro area, in what's called the Eurozone. Okay? So, the Euro zone countries have 12.1 trillion. It's a little bit down from nearly, it did hit 13 trillion, July 2021. If you go back to America, and again, this is a kind of a bootleg M1 because the Federal Reserve is just asinine with their publications of different money supplies. 10 trillion. So 20 countries in the Eurozone actually have more in demand deposits and physical currency floating around than the United States. Japan. Let's look at Japan in dollars. All right. 7.6. Japanese, much smaller nation, but a huge economy, gigantic economy. One of the, for decades, the powerhouse of Asia before China. So roughly 7.5 trillion. Let's add up. Let's call it 12 or 12.5 trillion, whatever. That's 20 trillion. Plus another 10 trillion. That's 30 trillion. $30 trillion equivalent is these three countries' total makeup is an R. Been living in Europe too long. The total makeup of these three areas is 30 trillion. M1. Some people say that's the analogous money supply to Bitcoin. Again, it's not, because in this green shaded area, now let's put M0 for Europe, and the green shaded area for Japan. Let's put M0 for Japan. The difference between M1 and M0 is demand deposits. All right, that's sacred demand deposit, which a lot of people like to pontificate about without really seeing how it affects the financial system. The point is not much. People like to say that that's somehow analogous to Bitcoin. It is not. It is not. Bitcoin is a system. It's a financial system. It's a network. It relies on no intermediary. There is no fiduciary. There is no bank. There is no brokerage. Bitcoin is core of the system money. It is the base layer money. M1 or M2 or M3 are not base layer monies. So if we just look at these three broad blocks of currency, Japan, the US, and the euro area. These are indeed the three largest in the world, in the free market world. China would be the other one. They're not free market. We'll look at them soon. Probably not by tomorrow, but soon. It's a huge pile of currency. It's a huge pile of deposits, but it's something very different than what Bitcoin is. Bitcoin is not a bank account. You can say it until you're blue in the face that Bitcoin will take over the value of this bank account. Maybe it will, maybe it won't. But economically, legally, accounting wise, Bitcoin has nothing to do with a bank account. Now, a cryptocurrency exchange account is very similar to a bank account. Now we're starting to talk similarities. Cryptocurrency exchange accounts, like a Coinbase account, a Kraken account, a Bitstamp account, they are very similar to what you see in green here. Very similar. There are some practical differences. The first is that what is in green here is regulated by the state. It's a monopoly. Anything that is regulated or has a special privilege from the state is a monopoly, classical definition. So if you have a bank account in Japan or a Euro area country or the United States, it is regulated and insured up to a certain amount. Yes, I know there's no money backing that insurance. I know all that. It's a confidence game. I know. I'm just saying, practically, legally, it is different than Bitcoin. And an exchange account, even, because exchange accounts are not regulated at all. In the sense of regulated like a bank account. I think it's not a hard prediction to say that they will soon be regulated like bank accounts. And by the way, I would say, isn't that a interesting thing that something from nothing, which is Bitcoin, could build up an industry and infrastructure which is now taken on the traditional financial system. I think it's very interesting. I always know with this stuff, there's a lot of hard money people, Bitcoin people, people that want me to say Bitcoin's going to 1 million tomorrow, hyper Bitcoinization. But if you've been watching my channel long enough, you know that I'm not trying to do that. I'm just trying to look at the actual numbers, the facts, and then we can slowly get to our conclusions each video. So thank you for indulging me with that point. Another difference, by the way, between cryptocurrency exchange accounts and a bank account, which is the main sort of that sacred demand deposit, right? Which is the green portion here of M1. And technically it's the value is M1 minus M0, okay? So because I have to layer this money up. Really the demand deposit portions of Japanese yen is 7 trillion. For the euro, it is 10.5 trillion. Okay. And for the dollar, it is 7.6 trillion. Okay. It's the difference between M1 and M0. M0 is the cash. That's part of the monetary base, but it's also part of the public money supply. So that's why it's M0. So a key difference, again, to finish the thought, I always get on these tangents, between the demand deposit, the sacred demand deposit, and an exchange account, besides one is regulated, one is not, is that the ethos of the Bitcoin network at the moment is to do full reserve custody. Notice how I said the ethos. I didn't say requirements, law. Jesse Powell from Kraken, who I think is a great leader and obviously developed a hell of an exchange with Kraken, he said, look, he says it often. He says, look, if you don't want to put your Bitcoin on my exchange, don't do it. It's just a liability for me. I don't want it. He said, take your Bitcoin off the exchange. He's like, yes, if you want to trade and do stuff, we make our money from fees. But if you want full security and safety of your Bitcoin, withdraw your Bitcoin. That's what Powell has said often. Jesse Powell, not Jerome Powell. I completely agree with this sentiment, and he's explaining why it's actually a risk for Bitcoin exchanges to hold that much Bitcoin. It's a fact of life that we have to deal with governments and the law, as much as Bitcoiners wouldn't like to admit it. So when you become a single point of failure organization, even if you're a good one, a profitable one, a forward-thinking one that has great technology around a product, which is Bitcoin, a distributed protocol, eventually you may be forced to deal with some regulations. They may be bad regulations, by the way. I much prefer a free banking society where there is no central bank, there is no central banking regulation, and banks can hold whatever amount of reserves or gold or Bitcoin that they want. It's interesting, though. I'm just making the observation that if you look at these M1 supplies or the demand deposit supplies, which is the green, all right, minus the M0. If you look at these M1 supplies, which are, I just added it up and I forgot what's the value. 30 trillion of M1, whatever it is, 25 trillion of demand deposits. You're looking actually at two extremes of the way that sort of banking is done right now. One is a regulated, usually, though not always, and from the financial crisis, things have changed because of so much liquidity in the system, but usually there's a requirement of reserves, which I'm not showing here yet, that a bank will have to hold as a proportion of their deposits that they issue. Okay, let me get the exact number. We'll do it again. 7.5 trillion here. All right, this is M1 minus M0. 7.5 trillion. I already just forgot. We're doing dollar equivalents. Okay, so 10.5 trillion, whatever. Yeah, 20 trillion plus 7. Yeah, so 27 actually. More than I said, not 25 trillion, about $27 trillion of demand deposits you see here on these three charts. Japan, Europe, America. $27 trillion. And there are more, because this is only three. These are the three largest central banks for sure, also largest free market banks, banking systems. In a perfect world, which we don't have, banks should be able to hold any amount of money or gold or Bitcoin that they want in reserve. And if they hold too much, they will lose to other bankings on interest income. That is, if they hold too much reserves, if they don't lend out enough. Because remember, the other side of these reserves is the loans that they make. That's really the mega portion of a bank's assets are their loans. But if they hold too little, if they try to skimp out of reserves and they lend out too much in a free banking system, what happens? Other banks will start to notice that they're being a little bit tricky, trying to be too risky. And if other banks see too much of their deposit paper floating around in the market, what will those other banks do? They'll go and claim the gold. That's how it was in the olden days. They'll go claim the gold. Or they will, in a modern day, they'll go claim the Bitcoin. Again, I don't know what a reserve ratio is. Anybody who tells you they know what it is, including 100%, is laughably wrong, historically wrong. Look up the story of the Ayr Bank in Ayrshire, Scotland. That is spelled A-Y-R. Ayr. My Scottish friends told me how to pronounce it. Look up the story of the Ayr Bank and how that imploded fantastically because they lent out too much, and other banks in a free bank in Scotland just went and claimed the gold from whatever they were lending out. So in 2025, we have a system where it's highly regulated. We have a lot of red tape. It's very difficult to be a bank. It's now becoming very difficult to be a cryptocurrency exchange. Unfortunately, I'm not saying this is a good thing. But still, there is the ethos in the cryptocurrency exchange world where if you deposit Bitcoin into the exchange, they're going to probably reserve it 100%. Might not be exactly 100%. You know, Kraken does these proof of reserves, I've noticed. It's very difficult to account for these things fungibly, even with something like Bitcoin, by the way, because you're constantly, some people are withdrawing some people are trading, some people are using these earn instruments or these, whatever they're calling, staking instruments. But generally, if you're just in the world of a cryptocurrency account, at the moment, you have 100% reserves almost. And that's just kind of the ethos of the industry. But I would predict that this is going to fall eventually. It should fall due to market forces. Unfortunately, it's probably going to fall due to government forces, which is an unfortunate thing. But at the end of the day, we can withdraw our Bitcoin, at least for now. When they make withdrawing of Bitcoin illegal, then we will have a problem with the Bitcoin project. But at least for now, if you can withdraw your Bitcoin, then you can return to 100% reserve of your own standard. You just withdraw. You can't do that here anymore in the banking system. You cannot withdraw 1,000 yen or $10 or 10 euros worth of gold ever. It's not tied to the system at all. As you know, it's ended here. And really here, this was just a central banking standard from Bretton Woods after World War II. So it's been a long degradation of the gold standard. Hopefully, Bitcoin will not have the same fate. I've probably gone on too long on this topic, but the point is M1 is not equivalent to on-chain Bitcoin. M1 is more equivalent to an exchange account of Bitcoin, or broader cryptocurrency, but obviously I'm only recommending Bitcoin, and I'll just leave it there. So it's a lot of money. It's a lot of money. And no matter how you want to slice up the Bitcoin world, at $2 trillion in market cap of the network itself, that's way smaller than any of these money supplies individually or combined. But again, Bitcoin as a network is still not comparable to these paper tickets or fiduciary media, which is what is in green. It is only comparable to, where did I lost it now? To this one, the monetary base. And of the fiat monetary base, which is 25 trillion at the moment, all right, 26 trillion. Obviously at 2 trillion, a little bit of a $2 trillion market cap, Bitcoin is 10% of fiat money. That's the proper metric. All right, enough on that. Let's go back to the euro. So let's stick with USD for a second because no, let's not do US. Let's go euros. Right, so this is how it actually looks in native euros, right? And then from here we don't have euros, but we have backwards compatible Deutschmarks, Dutch guilders, Belgian francs, French francs, pesos, or pesetas. You know how it is. For the broader money supplies, this is every currency. For the base money, I only have the French franc, Italian lira, Deutschmark. Anyway, you'll get the idea. So M0's here. This is physical euros in circulation. Notes and coins, only $1.5 trillion. Let's compare that to dollars. Again, just to be clear. Remember, dollar, euro, roughly the same rate. Okay, but just to be clear. It's $2.2 trillion in physical dollars, notes and coins, mostly notes, around the world. For euros, it's a bit less than that, right? With the exchange rate, it's a little bit more dollars. All right, I'll show you exactly again dollars. 1.7 trillion, still less than the US dollar. But these are the basic money supplies, okay? Now let's go out to M3. What's the difference between M1 and M3? And is there an M2 in between? Yes, but it's pointless to show because there's just too many things on the chart. Yes, there's an M2 between M1 and M3 here. But what is the difference? M2 is less regulated retail deposits. M3 is less regulated institutional deposits. All right. So when you start to get into your brokerage accounts, money market funds, repurchase agreements, that stuff is in M3. But if you're a retail, and there is no repo for retail people, that's all in M3 institutional. But if you're a retail person, long-term time deposits, savings accounts are typically M2. And retail money market funds, that's M2 as well. I'm skipping all that. We're just moving straight to M3. How big is it for the euro? Actually, quite a bit smaller than you might think, which is another interesting thing. M3 for the Eurozone is only $16.8 trillion. Let's go back to the US for comparison. Let's put on M3. Ooh. Gigantic. Absolutely gigantic. Remember, the Federal Reserve doesn't publish this anymore. You got to go back, find it yourself, which I have been. And it doesn't even include Eurodollars, which is typically an M3 item, which is offshore dollars. 36.3 trillion compared to 10 trillion M1. So over 3.5 times. Look at the euro. In euros, way less. I do think that there is a lot of leakage here, meaning leakage that's not caught by European banking regulations, because Europe is way under invested compared to America. That's true. Most Europeans that I know, like, they don't even have a brokerage account. They don't trade stocks. There are some interesting fintech banks, like Revolut is more easily offering stock offerings. Even cryptocurrency offerings, although that's not real Bitcoin. If you buy a Revolut on Bitcoin, it's not real Bitcoin. As far as I know, you can't withdraw it. Someone let me know if you can. But the point is, it's probably in reality, again, the European institutions, because Europe's fragmented, it's big. I'm sure that I'm missing some here. M3 is probably bigger in some other, like anything that's not regulated or not even sort of monitored by the ECB is not going to be picked up. So one thing that was kind of big over the last 10 years was the peer-to-peer lending industry. So if you would have a deposit on an account that was like not a bank account, but like RateSetter was the first peer-to-peer lending company in the UK and others, and you thought you had cash there to invest, that's not going to be caught in this M3. It's shadow bank money. And even the point is, there's a lot of shadow bank money, probably not even counted here, primarily Eurodollars, offshore dollars. But in Europe, it's probably bigger, but we have what we have, right? This is the data. This is just what we have. So let's do a count again of now M3. Let's just look at it in dollar terms. So this was native euros, right? As published by the ECB. Let's do it in dollars. Euro was screaming here. I remember the euro was so strong compared to the dollar. I was well, when we went back to the U.S., it did feel good. You had a little bit extra dollars in your pocket, so thus the dollar balance has to be higher because the dollar interest rate is was bad here pre GFC, and then that kind of collapsed, and now it was like $1.60 here to €1. Now it's $1.10. And then let's look at Japan again in dollars just to see. All right. So now we're looking at M3 in the tooltip, 11.2 trillion for the Japanese yen, 19 trillion for the euro area. So we add those two, that's $30 trillion. And we add the US, that's another 36 trillion. So it's 66 trillion. So let's talk about that number for a second. Top 3 currencies in the world. The yuan is also there, but it's very tightly regulated communist economy, and it's not a great example, but we'll count it up soon. Hi, Gio. Okay, so they use it now. They allow withdrawals. That's good. That's good. I wasn't sure. I imagine their KYC AML is a pain in the ass, but that is a pain in the ass for everybody anyway. So it is what it is. But that's good that they allow it now. So this $67 trillion in global M3. Good morning, Sandro. No, I think this is terrible. I should talk about this savings standard that they're talking about. Give me a second. I'll come back to this. Yeah. Typical exchange accounts going to be better for trading, for withdrawing, depositing Bitcoin. Obviously, they've been around a lot longer and they have volume. Personally, I wouldn't recommend something like Revolut for that, but people can do what they want to do. So just to finish the thought on the value here. And I'll get this eventually in one picture. I know it's confusing going back and forth to all this stuff, but look, we got native euros, euros and dollars, native yen, yen and dollars. Only on this channel, you're going to get all this detail. This is better than any Bloomberg terminal. $67 trillion equivalent in M3 money, which includes basically bank, non-bank deposits, brokerage deposits worldwide, top 3 currencies, 67 trillion. It's safe to say, all right, let's extrapolate using my monetary base. Okay, so here I do have a full survey, right? I have top 50 currencies in the world. Let's do this. Roughly 15 trillion out of 26 I'm accounting for here. Remember, there's 60 currencies in that 26. Sorry. So yeah, 60%. This is 60%. Okay. If we get 60 trillion in M3 for the dollar, euro, and yen, then 60% would mean 100 trillion is M3 still. And that's usually a number. It's funny. That's a number I've thrown around for a long time, is 100 trillion, without actually personally counting it up. I know the IMF has their estimates, and you can find it on TradingView, but I just personally need to do it myself. It kind of sounds pedantic, and it is, but the math roughly works, all right? It's going to be about 100 trillion is M3. And that's probably not even counting everything because, like I said, I'm not counting euro dollars because I don't have a good basis to count it. Nobody does. So 60 trillion for the top 3 currencies. Is So if we extrapolate and we assume M3 money is worldwide currency, all deposits, could Bitcoin accrete into that value? I think, yes, it actually can, but it's not going to do it in the way that you think. First of all, we're not having hyper Bitcoinization happen tomorrow. No matter what anybody says, I just think it's not going to happen. But this brings us back to the chart, which I've shown a lot here, is that if we can extend out this 26 trillion to a point in the future that might meet Bitcoin's power curve growth, then that is something that could make sense. Okay, so here it is again. Now world-based money. Now I have a different number than 26 trillion. I got 43 trillion. Why is that? Because I'm including gold and silver. The vast majority is gold, but that's brass tacks. That's what's happening here. Because I do think you should include gold. Gold has still been going up. Central banks reserve more gold. It's still money, even though people don't like to talk about it as legal money. So 44 trillion is the number. So if you take this 26.2 trillion, the black circle, plus all the gold in the world, you get this number. All right, and then we have our Bitcoin power curve, 2 trillion. So now since we added gold, the dominance now is not 10% of the 26 trillion. It's really only 4%. Okay. 5%, 4.8%. And we extend it out, and then we get to this 2043 period. And when does that happen? 150 trillion. So this, in my view, is the best way. It's like, it's ontological, is apples to apples. I'm not making up any numbers. I mean, yes, we don't know the future, but these are based on pretty strong trends for both of these. It's a power curve, obviously, is the black. Exponential curve is the green. Straight line on log scale. And it's all the world data. So I think we could get there. And then, like I said, probably 10 years from now, 2 halvings from now, we're really going to get into some serious discussions when we're up to about 50%, which will be 2037. And keep in mind, even when you're at 100% here, that's still 50-50. That's still, 150 trillion in fiat money and gold, and 150 trillion in Bitcoin value. No one knows how this is going to come together. This is very philosophical from this point, but I wouldn't bet on doing anything else because they want to protect this stuff as much as they can. Okay, back to Sandro's question about the Bitcoin savings standard. So the EU knows that they don't invest money. The retail people don't invest money. They literally live, way too many people just, it's expensive in Europe, high taxes. If you don't have a business and savings and a natural dividend from your business, like you just don't have high savings rate or much savings at all. So this is, again, I don't want to go into too many different topics, but a good reason why the U.S. has such a huge M3 money supply, it's a couple reasons. First of all, yes, they have the dollar standard. They can print whatever they want. Yes, it's bad policies and all the rest, but that's also a reflection of, people earning in the stock market and cashing out. There is a lot of money market fund balance behind this and just other deposits. I mean, it's not like there's nothing. Even though these are bank liabilities and brokerage fund liabilities, there's not nothing behind these liabilities. There are assets like loans and stock investments and bond investments. So the U.S. does have a higher savings rate, higher investment rate for its populace, retail or institutional. Europe just does not, and you can see it here. So what that savings, this savings standard, as they're throwing around, is basically trying to take some of this retail money, which is huge, bigger than the United States, right? A lot of these retail deposits, and funnel it into investments that are like to me just sound like communist. I don't know. I haven't heard a good explanation yet of what the savings standard is going to invest in, but it's not, it's not free market projects as far as I understand. It's EU led gargantuan ideas that you might make a little bit of interest here and there, but it's sounds a bit communist. That's my uh, that's my view. ECB economists propose directing retail savings to capital markets. Precisely. I mean, these are the same economists that tell you Bitcoin is going to zero. So many things to say about the euro I wanted to say on this stream. I mean, did you guys know, and I know this firsthand because I have friends at the Latvian central bank and I've talked to people at the Estonian central bank, and I'm sure this is the case, every single European nation that is part of the euro, there are 20 now, they all hold the plates for their original currencies, right? I'm sure if you might have suspected this, but no one trusts the euro that much, even in the ECB member countries, that they're just all in on the euro. We all have our original plates, so you can go back to Lats in Latvia, go back to the Kroon in Estonia, go back to the Deutschmark in Germany, and it might happen. Again, I'm not predicting. It's just there's so. If you're a small country, the Baltics generally appreciated joining the Eurozone because you join a big market, less friction. But the big countries, yeah, you have less independence. Your job is completely outsourced to the ECB if you're a local central bank governor. Anyway, so many different things to talk about the euro. But here's another thing I wanted to point out. So let's look at the bank reserve portion now. Now, this is going to be a negative because this is something that backs all of these deposits at the end of the day, are bank reserves. It's not that much, although it's way more than it used to be historically. Remember, here's historical. Just like the US, not much bank reserves. It's a negative. All right, so let's take off M3, M1. Now this is monetary base. M0, which is physical cash, plus the bank reserves is monetary base. So this is the ECB's balance sheet. Here's the Fed's balance sheet. All right. And just for fun, let's do in native yen, the BOJ's balance sheet. Okay. Let's go to the euro. I had this quote saved. You guys remember this? Mario Draghi, when the Eurozone was going through a crisis, Germans were bailing out Greeks, and these hilarious meetings between Merkel and Varoufakis, where he wouldn't wear a suit. It's like Obama wearing a brown suit. Mario Draghi, whatever it takes, the famous quote by Mario Draghi, then president of the European Central Bank, referring to his commitment to preserve the euro during the European sovereign debt crisis. In a speech on July 26, 2012, Draghi declared that the ECB was ready to do whatever it takes to preserve the euro. This statement, coupled with the subsequent announcement of the outright monetary transactions program, which is basically QE, is credited with claiming markets and preventing the collapse of the euro. So let's look at how that actually looked at the time. This is June 2012. Draghi was saying whatever it takes when the ECB's balance sheet was only $2 trillion. 2 trillion euros. 2 trillion euros. So when the ECB's balance sheet was 2 trillion euros, Draghi was saying whatever it takes. He's going to do whatever it takes. Interestingly, they did let it slide back. As I said often with the United States, they also let it slide back. The timing was a little bit different, but you do the bailout, you sort of recapitalize, and then essentially banks were taking treasuries back, or boons, back on their balance sheet and not having money. They started to destroy some money, which was interesting. But this was the main speech. This was the main push, was taking the European balance sheet from a trillion euros, trillion two, to 2 trillion. Then they went back. And then now they had this, which was even before, like the Greek crisis came a bunch. You had I'm blanking now. A lot of different European crises always come up, but the Greeks were always around as a crisis. And then, of course, the big one with COVID. So it eventually went up to 6 trillion euros. Now it's down monetary base wise to 4.5. Savings of Bitcoin is a good thing. Yeah, I know. It's unbelievable. I mean, it's, look, we're still early. Not as early as we were, but still, we'll look at some Bitcoin stuff in a second. We're still early. Here's my point. Again, after all my lecturing and just you guys dealing with my charts here, people keep saying like this is going to zero, we're collapsing, implosion. That's not what they're going to do. They're going to print more. So, and again, I'm not saying that the only value of Bitcoin is from printing. Actually, precisely the opposite. As we know, it comes from adoption and other stuff. But if you want comfort in Bitcoin as a savings instrument, none of these central banks have a balance sheet that is smaller than what it was pre-GFC. And I need to do some trend lines to show you exactly. But you can see, even if you look at the all-time trend plus a little extension, I'm sure the trend is somewhere like here, like, I don't know, maybe 2.5 trillion on the reserve side. It's a negative number here, but they're still at 3 trillion. I'm sure that they're still over trend over the lifetime trend of this. And if something happens, they're going to print more again. So that's the euro. Here's the Fed. Again, they have destroyed money twice. They destroyed money here. They destroyed money here. Although they did do the reverse repo, which is complicated, but we'll come back to that later. No other central bank is really doing this reverse repo stuff that the Fed does. But they surely will if M3 money becomes bigger for these central banks. If Mario Draghi says he's going to do whatever it takes right here, and Christine Lagarde says we have great tools and we're ahead of the curve and it's all good right here, she's not going to give up on the printing press when the time has come. This is why all these deflationists, Robert Prechter, all these people all the years saying that, you know, they always would come to the conclusion that gold is the best. But they have the power, they have the control to print more. They're going to have financial repression. They're going to require you to hold, in the ECB's case, they want you to have central bank digital currency, although I don't think that's really going to last. I talked about that yesterday. By the way, I think I looked back a little bit on the stream. Sometimes often, I'm sure when I speak live, I can misspeak, but I was conflating CBDCs and stablecoins yesterday. As I talked about the Korean won, Korea is scrapping the CBDC program, continuing with stablecoins. That was always going to happen because if you had a CBDC account, I think I said stablecoin account, but if you have a CBDC account, that locks you in to what the central bank does. And that's certainly what the central bank wants. ECB is pursuing this, at least on paper. But your shareholders, i.e. the banks, do not want that because if you get into I said it again, if you get into a CBDC account on your phone where literally it's just you and the central bank have a relationship, that cuts out your main shareholders. It cuts out the profitability of banks, loanable funds for banks, and all the rest. So I don't see CBDCs taking off. And anyway, European central banks saying they're going to limit to like 500 euros if they try to do it. A key thing, you might be asking, okay, so if they just print, we're going to have hyperinflation and then it's going to go to zero. a key thing that Ben Bernanke did here was, as he was exploding the money supply, and again, remember, the reason it's negative on my chart is only banks can use it. It's core of the system money, okay? So we can use this, right? M0, which is 2.2 trillion. Most of it abroad, actually. Most $100 bills are abroad, my understanding. But banks can use this. So as Ben Bernanke was exploding this money supply, he also paid the banks interest on these reserves. So normally in normal banking times, banks have reserves like this. They don't want to hold on to them because they make no money. There's no interest. So they lend out and they have loans. And then they keep a portion of this on reserve. And they don't even have to have the money. They can just make a loan that's 10x this value because there are different reserve ratios. And then they make money on loans. That's how the banking system would perpetuate. But since they didn't want to take the pain, since they wanted to bail out and they wanted to increase the money supply, they started to pay interest. And this was a key thing of why this inflation didn't like leak into M1 here or even M3 here during these years. A lot of inflation, though, was directly credited from the stimulus, as you see here. But still, again, this is when they talk about their tools, their toolkit. Lagarde loves talking about her toolkit. They will pay interest on reserves. I mean, European banks even have negative interest rates on loans. It's just like insane. So there's going to be a lot more that they're going to do the next time a crisis comes around. All right, I've been rambling. Yeah, the fortitude comes for sure after drops of 67, 80%. Okay, so here we have the euro again. Let's now look at the multiples. All right, so here's the yen. Here's the dollar. Let's go back to base money. Add these two up, and it's the size of the liabilities of the central bank, okay? Some of it's for us, some of it's for banks. This is just how the system works. Okay, like I said, Europe is a work in progress. Here's another thing I wanted to say, actually. Remember I said that there's a changing composition here, right? So you have the original 15. I think it was 15, or was it 13? Can't remember anymore. You know, Germany, France, Spain, Belgium, Holland, Italy, Portugal, Finland. They started here on the euro. Slovakia, Slovenia, somewhere here. We joined. Estonia joined here. Latvia joined here. Lithuania joined here. So it changes. Of course, these are small countries, so it doesn't really matter. But it's actually a good point, going back to just looking at this. Forget the craziness. But even as we go like here, okay, if you look at this chart, you'd be like, wow, this is crazy inflation and all the rest. It also is a fungibility problem with money. So since physical currency only went to 2 decimal points, and even digital currency or ledger currency went to 2 decimal points, always in the United States. The reason there would be more physical currency and even more bank reserves, although they were proportionally less, it's not just inflation for inflation's sake. Again, I'm not apologizing for them. I'm just explaining how it works. There's like new banks coming into the system here all the time. New branches, new banks. And those banks need reserves. They need vault cash. So that's also what you're seeing here. It's not inflation for inflation's sake only. It's my little caveat. So we can see that with Europe here, specifically, like new nations are coming in. All right, but let's take from what I can have with the denominator and numerator, let's look at the demand deposit, all right, which is M1 minus M0. Let's look at that divided by bank reserves. Okay, this is a wacky looking one, but this looks, during the 2000s, this looks pretty close to America, 13, 14x. Let's go back to America. 10, 11x. This is your 10% reserve ratio. This is the green, M1 minus M0 divided by the black, what they hold in reserve in the bank, okay? So if we look at Europe, again, it's the green, M1 minus M0 divided by the black, or now I'm on dollar, but dollar equivalent of euro. Actually seemed a little bit riskier than America. Remember, 20x would mean 5% reserved. 10x would mean 10% reserved. And then the financial crisis, some weird stuff. And then here, Draghi, as long as it takes. The bank reserves as a proportion of demand deposits was only 3.5x. So they're way over collateralized, like way, just massive bailout money. Nobody's at risk of failing. And then they changed tune of that quickly. They're worried about inflation. So in the mid 2010s, it goes way high, actually, back to norms. But then like, we can't keep that up. Another round of QE. So it's a bit weirder what happened in the European story. But if you look at it at the end of the day, now it's 3.1x demand deposits to bank reserves. It's the same story in the US, 2.3x. It's the same story in Japan. In Japan, it's like been suppressed for a long time, 1.8x. I don't know if I'm boring people more, but let's do the last one, broad divided by base money. Okay, so let's take off this. Let's show M3. Let's take off M1. Let's take off, yeah, I'll leave this. Okay, so this is brass tacks. What we got now for the US. And as I've said many times, the financial crisis was more of an M3 phenomenon than an M1 phenomenon. You see that right here, pre-GFC, there's $17 in all money outside of the central bank, which is broad money, divided by central bank money. You say that was an extreme. And now, again, it's just a completely different scenario, like way bailed out. Everybody, there's only $5. It's like for every dollar that the central bank prints, literally prints, or on a ledger, there's only $5 in broad money. I'm not saying the system is like safe and perfect. I'm sure there's going to be another crisis, another problem, maybe with car loans, maybe with student loans, although they're trying to forgive all those. It's a completely different system than it was here with normal risk. Let's look at Europe. Same phenomenon. I wouldn't put too much stock into this high number here in 2002. This is changing over basically from the individual currencies to the euro. And again, how do I get, this is in dollars, but this number's from the European Central Bank. This it's actually this number's from the European Central Bank in euros. They use like a trade weighted rate to find an actual dollar euro rate going back to the 70s. Anyway, it's the same ratio. Uh, Not as much leverage though in Europe. 10x. You can see that it rises, right? Number three rises. Not as much leverage though, but again, same phenomenon now. Completely over collateralized, completely bailed out. For every euro that the European Central Bank prints, there's only 3.4 in broad money. All the brokerage accounts, all the money market funds, all the bank accounts, all the time deposits, all the repos. It's not that much. And they're still ready to, and then Japan is just like, forget about it. Japan will do whatever it takes to bail out as well. So the phenomenon is pretty similar for the major banks around the world, major central banks. Thank you, Gio. Yeah, they I don't know why they don't do live streams for Prague, but they don't. They will for Honey Badger. It will come later. So they filmed it all and they'll publish it later. But yeah, most conferences tend to do live streams these days, so I'm not sure why they don't for Prague. Okay, hopefully that's clear as mud. Lesson: financial repression. They're going to print. They're going to bail people out. They're not going to let the currency collapse. If it gets too tight between assets and liabilities, they will increase the assets for banks. That is, adding bank reserves. Everybody should see, even if you know nothing about central banking, this epoch since 2008 is way different than this epoch pre-2008, where we had a lot of more leverage in the system. So again, I don't see, whether you look at the euro, the dollar, the euro, or the yen in native currencies here, each one. Let's take this off. This green line is always going close to zero. It's like completely collateralized almost. Not completely, but here it's 17.5x, broad money to base money. Here it was 15x. At the end of the Soviet Union. It's kind of interesting. They brought it down in the 90s. But I see no end to their printing. And just practically, like people using currency, fungibility. I mean, no one's going to announce overnight, like, okay, we're going on a Bitcoin standard. Like, it's just not going to happen. It will be slowly. Countries will reserve Bitcoin. Here's another way to look at it, and I think this is interesting because a lot of the hyper Bitcoinization folks, mostly I see them in the U.S., like hyper Bitcoiners, the maxis, Bitcoin is everything. They're huge proponents of a strategic Bitcoin reserve, or states buying Bitcoin, like the actual state, the government buying Bitcoin. So just ask yourself here, if you believe that fiat is garbage and it's going to zero, yet you also want your fiat issuer to buy Bitcoin, and Bitcoin is good, and I agree with that statement that Bitcoin is good, what is that going to do with your fiat that you say is going to zero if it's now backed by some Bitcoin? It's going to preserve the longevity of that fiat. It's just, there is no other way to look at that situation. So you can't say Max Kaiser style that fiat is going to zero, and then also say, and which will happen, Bitcoin is going to be a major asset backing fiat currency, and then still have the thesis that fiat is going to zero. It's not going to work that way. So that is one of the main beliefs that I have, and I don't see any. Just look at these charts. I mean, it's number go up all day. they're going to do everything in their power to keep control of a currency that they print. All right, that's all I wanted to say for Europe, Japan, and America. Here's now back to, okay, so this is the growth rate of this. This. Back to this. We can put the colors back in, all the different currencies, but, sorry. Let me take out the rest of the world. This black line, the total, okay? How does it change natively? It's very hard to figure it out, but I have it for you. All the native changes of this currency up, down over the years. What does it look like? It looks like this in red. Okay, this is trailing 12-month figure. As you notice, I talk about this often. It's 12.7%. It's blended. Sometimes it's higher. Sometimes it's lower. Y2K was well higher because of Y2K. People were burying tractors. You know, ahead of the inflation bug. And then QE1, 2, 3 globally. And now we have Bitcoin coming in here. I would posit to you always, and I've said it many times, but I would posit to you that Bitcoin's growth in the past and now has nothing to do with this. Even though this is the most comparable money supply to Bitcoin, Bitcoin's growth has nothing to do with this. And let's just look at it. All right, so early years when we had, this is the change in the market cap. Okay. And by the way, the Bitcoin scale is on the right-hand side. So right here, you can see that it's 4 times bigger. So the scale maxes out at 40% for fiat. Bitcoin side is 160. Right, so the scale is 4x difference. And I'm capping it in 160. So we have 10,000% growth here. 2,000, or it was 10,000 in November 2013. That was a big high, right? $1,300 Bitcoin. What was fiat doing at the time? It was actually going down in money printing from the QE2 period. Had nothing to do with Bitcoin's rise. Fiat was coming down at that point. Bitcoin's still flying. Bitcoin goes into a bear. What's fiat doing? It's flat. Fiat's still flat here. Bitcoin rises to the next, rockets up to the next bull, 2017. This one, interestingly, kind of coincides a little bit. Bitcoin falls. Fiat is flat here. COVID, we line up more here in 2021. And then here, it seems like we kind of line up. But again, let's keep looking through here. What is fiat doing since 2021? It's flat. It's flat or down. What is Bitcoin doing? It's been rocketing up again, 120, 130%. You can put a curve now on Bitcoin. So fiat is exponential, 12.7% per year constantly. Bitcoin is power. Uh-oh. Why did that go there? Hold on. Let me reset that chart. Change my scale. Anyway, we don't need the curve at the moment, but you can see Bitcoin's roughly, it's moving at 4x the value of what fiat is doing. And sometimes Bitcoin is way up and fiat is flat. Sometimes Bitcoin's way up and fiat's going down. I think at some point this will match up better. But right now, I don't see it. Right now, it's just pure power curve play. It's pure power curve. So let me find this chart because I am not matching it up. One second. It didn't change. Why is that? Reset this chart. That's again why I don't put this stuff live on the site. Geo's got something. Yeah, probably. And keep in mind here, this green line is there is some overlap with Bitcoin and gold. So, well, with Bitcoin specifically, you can't see it because of my face, but let me take it off. All right. We have unbacked fiat money. So what that means is, since we already are counting gold and silver, and we want to compare basically Bitcoin with everything that's not Bitcoin that is money. So gold and silver. And then the fiat money, which is a liability in the modern central banking world today, it's a liability. It's a liability on central banks' balance sheets. But as an asset, governments do hold some gold, and they actually hold some Bitcoin. They hold about $50 billion worth of Bitcoin. So we need to do an unbacked fiat money calculation to put it all in one line. All right, so that means monetary base, which I showed you that 26 trillion, minus the gold, which is like 4 trillion, minus the Bitcoin reserves. You'll get a net number of like, whatever, call it 22 trillion. Add in the 20 trillion for gold and silver, and that will get you to the total number of the value, like 43 trillion here. But keep in mind, since we are always backing out Bitcoin reserves in this green line will then come down if more Bitcoin is reserved, because I'm always pulling out the Bitcoin. So these are two completely isolated money supplies. The one is Bitcoin. Obviously, it's Bitcoin network, and the other is all the other stuff. But fiat money can, let me come back to my ugly mug here. Fiat money can overlap with both Bitcoin and gold if they hold it. So we could catch this green line quicker if central banks buy Bitcoin. And as you're saying, will they start buying it when the market cap is higher or lower? I think they're just going to buy it organically, and it's not the main thought of them at all right now. Anyway, back to here. Why is this line getting? I have no idea. I have an error here. It's very strange. I need to fix this chart, but basically, oh, it's just calculating zero, so it's probably, I'll fix that probably for tomorrow, but anyway, let me see if I can fix it now. No. Anyway, what I wanted to show you here is this line, if it was calculating correctly, which is not, it comes down like this beautifully, like a power curve. Comes down. And it's actually about meeting the fiat at a ratio of 4x. Okay, so they would meet on this axis. This axis is 4 times higher than this axis. Okay, so Bitcoin is still 4 times more volatile than fiat. So I just don't think it has much to do with fiat at the moment. I think it has to do with adoption, people understanding how wallets work, transactions, all the rest. What do you guys think? You want to look at something else? Price. It's a long lecture again. Maybe I should stop. I feel like the money supply lectures can get tedious. And a lot of you guys have heard me say the same stuff again and again, but I do enjoy it. I think what you see here is something that you're not going to see anywhere, not even on Bloomberg. They don't like have this stuff put together in the way that I have. The lesson should be Mario Draghi was correct. He's doing exactly what he told you he would do, and they're going to continue to do it. It hurts the average person, hurts your purchasing power when you have so much central bank money relative to broad money. But I think they're going to keep doing it. Yeah, I'm very happy to hear this. I think that's the central bank I will approach next. This Nabolina, who's the central bank head of Russia, she has to be the only person in Russia right now who's apparently not afraid of being thrown out a window. Although perhaps she is afraid. She's just speaking truth to power. I haven't, you guys know I like to talk around numbers. I haven't graphed it all out, but what you've probably heard is that Russia is not borrowing on a government level to support their war economy because their reserves and their balance sheet is basically frozen in the West. This $300 billion equivalent of foreign currency reserves, which most of which is in Belgium, in Euroclear. So since they can't access those reserves to get into the capital markets and do stuff, they have been requiring companies on a corporate level in Russia to borrow for them. So you can see it in the bond market. The corporate bond market is exploding in Russia. Has been exploding for 2 years now. So I want to put all that together in a chart, and we can look at that. I think that's interesting. I don't know, man. You guys know I'm pretty even keel about almost anything, but when it comes to Russia, I lose my cool. So Putin had this like hysterical meeting in Minsk the other day where he's basically like ranting and rambling more than he usually does. He's talking to no one. He's not talking to the Russian people. He's talking to the Belarusian people who are not his people. But he's sort of rallying around saying he can't believe Europe is spending so much and going into debt. And why would they do it? So confusing. Why would Europe want to arm when we're just peacefully trading with our neighbors? That's a big question mark. There's a study, I mentioned this before. Let's see if Gemini can find it. I can't find it, but there's a study that says that if you can get up to 30,000 GDP per capita, I think that was the number, then basically, you know, the risk of war is way down. And, you know, many countries in the world don't have 30K GDP per capita, including Russia and Ukraine. Ukraine's 5K. Russia's 15K. Baltics are around 30K. Anyway, I will. I think it's probably time to do a little analysis of the Russian central bank balance sheet and the Russian government spending on the war. Lesson is always, though, as a Bitcoiner, take some comfort. None of them want a hard landing, as they call it. They always want soft landings. They want bailouts. If they have to pay interest on the reserves, interest on that excess money, so that money is not lent out and causes inflation unnaturally, they will do that. It's not a good thing. It's certainly not a good thing, but it's not something that, in my view, will change anytime soon. And I think you just look at these charts, you see the direction of this liquidity. It's so massive. Remember this 3x, just to show you exactly how it's calculated broad to base. So M3 is the broadest money, 18 trillion. It's going to be same in euros or dollars, but let's do it in euros since most of us are in Europe at the moment. 16.8 trillion M3 money. You subtract the M0, because M0, which is cash, is the only government money that we can use. You subtract it out. So you get to like 15 trillion. So 15 trillion is broad money, bank money, non-bank money, shadow bank money, all the money that's calculated in the system by the regulator. 15 trillion divided by total base money, which is included M0 and the bank reserve money, you'll get 3.4x. That's what it means. And so usually a higher number is riskier. Again, this is kind of this is high because of the transition. This is kind of an unnatural change. It's usually somewhere here, let's say 10x. That's actually relatively safe, right? Because remember, what was the US? It was 17x. And I can show this number as being crazier if I even take out M0, right? I've shown that before too, because M0 is really a non-levered money at all. I mean, M0 is out there. We have it in our wallets and in our safes and in our grocery store tills, but you don't really lever it. You really lever the black stuff. So you'd get an even more extreme number to show you how crazy M3 was for the US. But you still see it here. Basically, broad to base money was 17x. Remember, that includes M0. And now, in all cases, 5x for the US, 3x for euros, 2.3x for Japanese. There's so much government money backing broad money. I just don't see how this trajectory changes. I'm not going to complain if somehow all the central bank governors around the world make a decree that they're going to genuflect and say they're sorry for all the cycle-driven inflation over the years, and they're going to just switch to Bitcoin. We'll just move to a Bitcoin standard, but that's not going to happen. A good question from Gio here. I do. I do like Constantine. There's an interesting. I've tweeted at him a couple times. Obviously, he's much more popular than I am. But he interviewed his father. His father was working for the special services in the 90s in the Baltics, trying to keep the Baltics closer to Russia. Obviously, the Baltics want nothing to do with Russia and are much better off not a part of Russia or the Soviet Union. He seems to understand that, but his father had very longing feelings for that the Baltics wanted to be part of the CIS countries, which is the Commonwealth of Independent States, this sort of loose amalgamation of countries that were once part of the Soviet Union. Ukraine's now out of that. Georgia's out of that. The Baltics are out of that. Azerbaijan's talking a tough game to Russia now, if you haven't seen, after their plane crashes and stuff. But anyway, I like Constantine. I'm always bringing it back to myself, of course, with the Baltics, but I do like him. He's coming into big arguments with those, alt-right, hard-right people with the Israel stuff. I'm generally on that side, though. I mean, we don't have to get into all this, but I remember you said some point about how if you were in occupied Gaza, obviously you're not going to be too happy with the current system. I imagine nobody's quite happy with the system, but if your state is an authoritarian terrorist state, which is what the Gazans have to deal with, then you either need to overthrow it or ask for help from outside. It's a very difficult situation there. But I feel the same way about Russia, right? I mean, Ukrainians feel the same way about Russia, at least from that side. It's not an apples to apples situation, I know. He won't even ask. He won't ask the question. He won't allow himself to have anyone ask him that question. I have these money supplies for Russia and for even Iran. What's inside this other, okay, is 45 currencies. Iran would be a G20 nation if it was a normal nation. It's a huge country, right? Ted Cruz doesn't know the population, but it's a huge country. Terrorist, radical Islam, but terrorist financing, but still huge. They have money supplies just like everybody else. Iran was the hardest to decipher, by the way, because they go in the old Persian calendar, which starts in like March. So I had to sort of work it back to normal months. It's very strange. But, Iran's there, Israel, Russia. They're all inside this number. 4.89 trillion in base money. It's a dollar equivalent. Hello, D-Max. The question is a bit confusing to me because you're talking about money supply, Bitcoin market cap, and stocks. But I can show you on my site, again, just how I break it down and what I believe is the best way to break it down. So this is what we just talked about all the time, or what I usually talk about all the time. This is gold available, silver available in dollars and native units, right? You got it all there, 20 trillion. And then the top 10 central bank monies, and then Bitcoin. Okay. So this is how the money shakes out. And in totality, it looks like this black circle. And then if you go down here, this is my API here is messed up, but just for this chart about the UTXOs, you go down here. I have top 10 stocks and Bitcoin. This updates all the time, so you can catch it. But this is how this is just, Bitcoin is not a stock, but if you wanted to layer it up against stocks, it looks like this. It's the sixth largest asset, publicly traded asset, I should say, in the world. So that's huge. But Bitcoin is not analogous. Like it is in terms of liquidity. Like some people want to hold NVIDIA, some people want to hold Bitcoin. But it's a totally different thing. Stock certificate is just stock certificate is an ownership of a company. When you hold Bitcoin, it's more like holding gold. It's just different. But yeah, I do have it here, just if you want to see how it looks. And this updates all the time. Earlier this year, they passed Facebook. It's bounced back and forth. But this is it. So you can find all that on this page. Money supply, top monetary assets. What I want to do, which would be cool, is we can see basically how this has evolved. And it's probably only going to work from like 2000 for now. Yeah. But we see how this base money supply has evolved versus the broad money supply for all currencies, or at least like the top 10. Okay. So you add up this M3. And like I said, I suspect it's going to be something like 100 trillion right now. Okay. So, and then you just sort of track that ratio. Mm. Well, to do a proper estimate of your question, you'd probably have to have all that surveyed. I don't have it at the moment. There is a difference between money and assets. And so for example, in the Federal Reserve's website, they have this time series. I think it's quarterly. It's total financial securities, total financial assets in the system. And it's a couple hundred trillion. All right, so that's going to include stocks, bonds, government bonds, corporate bonds, and just all the ownership mark to market of those. And that's even well above the money supply, right? So there's different ways to slice and dice it. You see a lot of people on Twitter try to, say, okay, if real estate is X and Bitcoin is Y, where could Bitcoin go? I try to keep it a little bit simpler than that, or at least just keep it to the relevant money supply. And to me, this is the most relevant money supply is right here. And if you want to project it out, it's here. It's going to go on the power curve. Until someone can show me a better model. I can, where's, Balaji put this out in 2023. How do you ring the fire alarm on the internet? You guys might remember this. This was in 2023. And it's like the bit signal. This is just not going to happen. It's great marketing. He also put like a crazy bet in with someone, I think, about this time. I don't know why he did it or who he bet. I forget already. I mean, all this is great. I'm into all the marketing for it. But if you want to live your life like comfortably, do your work, own your businesses, collect your dividends, buy Bitcoin when you can, I think this is not really helpful probably to anybody, because if Bitcoin does do this, then it probably means that the system itself is like way worse for everybody. And what I just said before, I don't think even the most hardcore hyper Bitcoinizers believe that, because they think that states should buy Bitcoin, and I believe that they will buy Bitcoin. And so if you believe that Bitcoin is good, states buy Bitcoin, fiat is bad, but fiat will now be backed by a good thing. What's going to happen to that bad thing? It's going to become less bad as you have more Bitcoin backing it. So I'm more of the, of the school of just looking at the data. I'm more empirical here, and I don't see any of this. Maybe in a coordinated effort, like this was a big change, right? Okay, so this was one scenario. No one was really sure how levered the United States money supply was or how much it could take, right? When you had $17.50 of broad money per every $1 of base money in 2008, no one knew. Like, yeah, that was an all-time high, but could that have gone higher? Apparently not. It didn't. And then obviously the world changed. It was like major bailouts, major everything. I could see something because of a crisis, right? And where that crisis sticks its head out, I don't know, or war. I could see kind of a next level, a Bretton Woods 3. This is talked about a lot, right? A Bretton Woods 3. And first of all, the first thing on their mind is not Bitcoin. It's gold still. Because central banks hold, going back to this page, in gold, central banks hold 1.2 billion ounces of gold. All right, this is gold in central banks. This is gold in bullion form, an additional 1.5, and then 3.1 in jewelry, fully half of the gold, and then this is gold kind of cycled through industrial loss. So it's 7 billion ounces of gold. Okay, this is how it looks. And by the way, when I do my gold valuations, you'd never include this industrial. This is all estimates. It's not a blockchain, but this is roughly how it looks. So just doing the math, central banks hold 1.2 billion ounces of gold at $3,000. I know it's more than $3,000 a month. There's roughly $3,000. You're getting close to $4 trillion. It's $4 trillion, okay? $4 trillion worth of gold that central banks hold. So if we would go back to a situation where, like, we have a reverse Bretton Woods, where the system decides to get back to sound money and they want to do good stuff, right? So we have a reverse where we don't need to go all this massive bailout money, but we can take more leverage because we have more gold or whatever. And we push this number back higher because now it's completely suppressed. And somehow we can push it higher because we have sound money backing the currency. Well, they already have $4 trillion worth of gold worldwide. Backing, actually, this is better. $4 trillion worth of gold backs this number. So the first thing they're going to be thinking about if they revalue it or, I don't know, maybe they add some redeemability or something to the system, right? To peg their currencies to gold. It's a very risky thing, and there's going to be a lot of arbitrage if they do it, and it won't be a smooth thing. But if they tried to do that, the first thing they're going to be thinking about is gold. Like I said, gold is close to 10% of what they already print. All right? See that? 4 trillion they hold in gold. It's the number. I should make a chart of this probably, but 4 trillion they hold of gold. The value of their currency that they've printed, central bank currency, is 26. So you're getting close to 4.5%, 5%, whatever. Bitcoin is very small component. They hold $50 billion worth of Bitcoin. They hold 500,000 Bitcoins, all governments in the world. So I think it can be part of the change. It can be part of it, and maybe they will do something like that, but I don't know when it's going to happen. I don't know how. I would just assume they're going to keep printing. So it's better to hold Bitcoin anyway. Yeah, but it doesn't change much. In fact, it's much better than any other model. So I've shown this one a couple times. I don't know if you've seen it. I'll pull it up here in a second. For example, the stock to flow. All right, there are a lot of problems with stock to flow, but here we go. So we're just different Bitcoin price models. Let me take your comment off. Talking about how the power curve would adapt or adjust. I'm taking everything off. Bitcoin's clearly not exponential, by the way. If it was exponential, it would go in a straight line on log scale. This is just not what's happening. Okay. But there's actually two curves here. One is the all-time, which is number 2, and one is the trend from 2016, which is number 3. Notice how you can barely see the difference. So I zoom in, zoom in, zoom in, zoom in. Now you can start to see the difference, barely. So it's $5,000 off. It's an unbelievable trend. It's $5,000 too optimistic. I talked about yesterday this. You can see how close. Actually, no, it was even higher here. The 2018 trend was I think a little bit higher actually. But anyway, this basically answers your question. Yeah, it does move. It moves every day, but the rate of its adjustment is so slow that it would only, one would have to assume that it's a correct model, because it's just, you could stop calculating from right here for number 3, right, roughly here, and then stop calculating here for number 2, and as you see, they're basically the same. Now, contrast that to the stock to flow models. Okay, 2020 is this wildly optimistic one. That's here. Okay, it's gone, never coming back. Contrast that to the 2019, which is the original model, is here. This one's a little bit catching it more, but again, if you just look at the way that the power curve works, it catches it. Yes, you do touch the high here, but that's not what a model should do as a mean. That the main trend you would think would be around the data more. It's just clear that the stock to flow is kind of a bastardized version of the power curve. It is a power curve, by the way. The stock to flow, he's using a power relationship. But another problem with the stock to flow is with both of these models. Number 7 is worse because he uses like platinum, palladium. Number 6, he only uses gold and silver. But again, he's throwing in exponential assets into a power model. And that just doesn't jive. An exponential asset, like if you just did an exponential curve on Bitcoin, you could see it actually goes through his 2020 model. So to be clear, what number 1 is I'm just drawing a straight line through. I'm shoehorning an exponential curve onto Bitcoin's price action. It's not bad, but at 86% R squared, it's way worse than the power trend, which is 96% R squared, which is an incredible fit. And his plan B has done this 2020 model. He's also taken exponential assets like gold and silver and applied that to his coefficients. So it doesn't make any sense. 2019 is better. It sort of hasn't. People are waiting for it to hit. I'm sure it actually could hit again. I'm not sure, but let's say it could hit again, maybe even here, all the way out in 2028. But I'm pretty sure it's too aggressive as well. And compare all of those with our 2016 power curve, as you see, layered over almost perfectly to the all-time. I don't know the standard deviation away, like how far the 2019 is from the power. I haven't calculated that. But just in terms of raw numbers, it's like 56. So here, let's take off the exponential and let's put in 2016. So 2016 is our base case now. It's not the all-time. So if you look at number 7 divided by number 3, which is the 2016 power trend, you'll get something like 56 or 54. I'm just going from memory. I had this in my presentation in Prague. You get something like 54, 50 times worse. And if you look at 2019, it's 7 times worse at the moment. Of course, that changes as time goes on. Maybe it'll get better for number 6 for a little bit here, but at some point it's going to keep being more aggressive than what's actually happening. My projection. I don't know, man. I can't follow that guy anymore. There's someone who's probably used too many drugs and on a bit of a power trip. But we will see. It's just standard stuff to me, like another 2-3 trillion in the debt. That's bound to happen. This stuff can go on a lot longer than you think. Not forever. I'm not a modern monetary theorist, for sure. Deficits do matter. The value of the currency could fall. But the dollar remains the best looking horse in the glue factory, other than Bitcoin, of course. Yeah. He grifts. He definitely grifts. He was grifting on Dogecoin for a long time, which he was obviously doing with the Doge agency, just in name only. But I don't think he's gotten a full understanding of how it even works. Like you said, I don't think he understands it. Just doesn't know how UTXOs are created, destroyed. Uh, when you hear people talk about the currency and they say it's a transactional currency versus something else, money or something, you know that they've already lost it. They have no idea what's actually going on when they say it's a transactional currency. Hello, broadsword. Confidence game for the fiat? Yes, for sure. Fiat is all a confidence game. The modern monetary people say that deficits don't matter, debt doesn't matter. And if that was the case, I would just like one of them to explain to me why Argentina doesn't have a very strong economy, or Brazil or Zimbabwe, because they have financed their deficits with printed money for a long time and it hasn't worked out for them. Um, don't know if I don't want to go on a tirade on money printing versus base money, but yeah, I should. I have a good chart of the black market rate, the blue dollar rate versus the central bank rate, and it's compressed a lot. Malay's done a good job. I mean, at least from that standpoint. Um, it's modern in that you just deficits don't matter. Doesn't matter, Geo. Nothing matters. You just keep printing. Hi, Daniel. Yeah, partially it is. Partially it is. The challenge on a macro level, it seems to me, is that no one can rein it in, right? Or at least no one wants to rein it in, right? Until it isn't. And then here's another challenge is, when you had this M3 clearly exploding versus the rest of the money supply in the United States, and then the crisis, uh, you could make the argument, and I would make the argument, that what they were expecting was something pretty much akin to this. They were expecting, even though M3 money wasn't guaranteed by the government, um, they were expecting the bailout. That was the moral hazard. And as you can see, every currency, the top three currencies in the world here are precisely doing that. Japan has started it sooner than others. So it's the moral hazard that's the biggest problem with the fiat currency. But again, how the solution comes about, I can't say for sure. It could take 20 years. Uh, it could be that once Bitcoin becomes something like 50% of the rest of currency. Um, we get onto like a SAT standard worldwide instead of a dollar standard. But it's very philosophical from here. I'm not sure. I'm not sure because one thing that I would bet on is that they will not give up the power to print. And even if they were forced, a lot of people say this in Bitcoin, right? Like it will force the government's hand, no more money printing. They can still borrow. The government still has the guns. Government makes the laws. So you can still borrow as a government entity in the world marketplace without, printing money. And if you have a bunch of Bitcoin in your reserves, maybe you become a pretty good debtor. Maybe creditors will want to lend to you still. And so if the United States gets ahead of that, or Europe or Japan or wherever, Metaplanet, you only have one hotel, but you got a lot of Bitcoin. That could also change the picture. Like, I just don't think there's one lever, Bitcoin, it's going to be everything great. It's clear that there's many things that are competing for I don't know, supremacy, economic supremacy, and it's geopolitical issues. Countries have to form alliances, or maybe a neighboring country could invade them. Who knows? It gets very philosophical. We're still early. We're way early. Remember, I asked Scaramucci if we're at a Wall Street moment where Bitcoin is just like gold, copper, platinum, oil, if it's just kind of a commodity, and he didn't think so. I don't think so. I think most people don't think so. Still plenty early. Newsletters will try to scam. Used to be gold, now it's going to be Bitcoin. Power law will get us to 4 trillion. By the way, I like power curve over power law. People get triggered by power law, just joking, but I usually say the power curve, even though power law is like, I guess, the scientific way to say it. Because we have exponential curves, linear curves. 2027. Very close. But again, if you asked me, is Bitcoin going to move in? Just give me a second here. Is Bitcoin going to move in a very predictable not linear, but predictable pattern up this power curve, like some people are talking about? I would still say no. So I think, though the trend could be 4 trillion by 2027, we could be coming out of a bear where we're back down to 60K in price. Who knows? But it is pretty interesting now. I talked about this yesterday. Obviously, we're just moving right along the trend line. But if this is a $4 trillion market cap, right, at 180, 200K per Bitcoin, it's totally possible that this could be after a big bump, and then we're actually not at 4 trillion because the actual price is well under this. But I wouldn't worry about that for now. Hardest thing is to sell your Bitcoin. Don't know. I don't know. He can't buy forever. Fred Krueger's on that kick now, talking about how, I mean, look, it's great what he's done. It's clever, creative. But he's also trading on limitations of other entities, right? People are willing to accept a much smaller return in MicroStrategy paper with underlying exposure to the Bitcoin versus simply buying the Bitcoin itself. I don't mean MicroStrategy stock. I mean like the convertibles or whatever the different notes that they've been offering. It's obviously it's been a lot of different instruments over the time. It's very creative, very creative. Yeah, I hope so too. I mean, I think it is true. These were all retail-driven markets, even here. This was pretty retail-driven. We didn't get options until here, really futures, right? Cash-settled futures in the CME and CBOE. There's a lot of institutionalization here, no doubt, no doubt. But as I showed in that chart from Checkmate yesterday, you can look at all the selling of long-term hodlers, even over 3-year hodlers, and it can be to the tune of thousands of coins a day. So while Saylor is buying, some people are dumping. I would stick with this. Again, not financial advice, but I would stick with this as it's the main driver. Not even the money supply drives it. Where's that damn chart? Here we go. Bitcoin can be way up, money supply down. It can kind of line up like it did here and even here. But now Bitcoin's way up and money supply has been flat. So I do hope we have some booms and busts. Again, not to hope that people lose, but it's markets. I mean, they go. What I'm pretty comfortable and confident in saying will not happen is this. Just like to the moon. It's been projected so many times and has not happened. Doesn't mean it couldn't happen. Doesn't mean I wouldn't be very happy to be wrong there. And we get a coordinated message from central banks in the start of 2026 that they're all buying Bitcoin. You're in the UK, right? If you want to say. Yeah, I'm not a fan of the M2 to BTC price correlation at all. Few quick reasons. First of all, M2 is just the United States money supply. As I've talked about, there are many different money supplies. Secondly, It's not M2, it's M3. That's the money supply. Fed doesn't publish it. You got to go back and find it yourself. So this is what I've done for you here. Uh, M2 is like 15 trillion less than this. M3 is less regulated institutional instruments. M2 is only less regulated retail instruments, cash instruments over deposits. This is M1, which includes just bank deposits, the sacred demand deposit. M2 is between these two. I'm not showing it on this chart, but those are the two main reasons. First of all, it's global. So you got to find a money supply that's global, like this, all currencies, not just the dollar. Secondly, it's not the right money supply. It should be M3. Thirdly, it's the monetary base is what Bitcoin is comparable to. So whatever people are finding with these trends and lags, I'm not there. What a place. 25% Norwegian. I just say that like all American says it with their heritage, but what a place. Beautiful, beautiful country. And you'll notice DMAX, I have been on TradingView a little bit for some of these streams. Maybe we can get on there again, but I'm not look, by all means, if people can trade this and they think there's alpha there and they can actually trade these sort of wacky trends like this 11-week lag from M2, I would say go for it, but caveat emptor. And I'm just not a draw lines on TradingView kind of guy. I like more macro, big picture, scientific stuff. And I'm not saying like again, I'm not a trader. I'm just not a trader. Bitcoin, I'm lucky to be in the Bitcoin market. I'm lucky that we have this asset that tends to go up in this predictable manner. And when I say predictable, I mean like a scientific kind of predictable, not a number go up predictable. Although it does. You need to be careful of your models. I published my first power curve here. It's like talking about something very personal. My first power curve I published here, 2018. Plan B published his solid line stock to flow somewhere here. I don't know, actually maybe mid 2019. And think about all the fanfare that stock to flow got over the years. I don't know. All right, guys, I got to do some other work and some yard work. Yeah. Well, to be honest, I haven't fully inspected it, but the lag charts, I'm very skeptical of the lag charts. M2 is just not the right money supply. It's not. And if it was, because M2, it is true, M2 is more retail than institutional. It's not going to be right for long because we got a lot more institutional money flowing into Bitcoin, and that's up in M3. So, for all those reasons, I'm highly, highly skeptical of an M2 to Bitcoin price lag. Remember, the stock to flow was a 95% R squared for a long time, too. It might even similarly be one of them. So R squared isn't everything. I got to look at the 2020 R squared. It might be, no, not 2020, 2019. It might be not terrible, but nothing beats what's going on here. Whatever. Plenty of people to obviously get the edge from, and I'm curious if you. I probably need to do the work to dissect it, but I'm not going to do it. There's too many other projects at the moment. Ping me if you find anybody who has a good breakdown of that. My three things are it's not M2, it's M3. It's not global. And it's not even M3. It really should be monetary base is the money supply that you would compare with. Which is here. All right, everyone. I think that's going to do it for me today. Thank you. Thank you, D-Max. Appreciate it. It is my pleasure. This is a lot of fun for me as well. It's a long time bringing this whole chart engine to fruition, like years and years, decades, even. So I'm glad to do it now. Let me know if you guys have anything else to chart. Like I said, we'll continue on with the broad money supplies. We've done the United States, we've done Europe, and we've done Japan. And we'll just continue on, see what the multiples show. All right. Thanks again. Have a good day, guys. See you tomorrow.